Panel tonight, we're very lucky to have Joe Mager from the Motley Fool and also Stuart Jackson from Montgomery Investment Management. So in this type of environment, are you buying or are you selling?
Oh, look, we're selectively buying. We remain focused on our core process where we're looking for good quality companies, ones that have good strong franchises, good demonstrated cash flows. And inherently those businesses tend to be fairly defensive at the same time and a little less impacted by this sort of volatility. So that's where the focus for us lies, rather than playing the more speculative end of the marketplace where you've got a lot of leverage from external factors that are much more difficult to predict, and in a lot of cases as well, as we see with Glencore too, and then you're overlaying that with enormous amounts of financial leverage as well. So they're the sort of stocks we try to stay away from generally. So,
so any energy or material stocks that you're looking at the moment?
Not at this stage, I must admit. We look at them from time to time, and we screen them and so forth. But at this stage of the game, we haven't found anything that really meets our requirements.
Growth in a slow growth world, and growth has become pretty expensive, looking at Blackmores and Bellamy's and Capilano Honey. What do you think, Stuart?
Yeah, look, as I said, we're more stock picking for franchise and for growth, companies that can reinvest in their business at a good rate of return. So it's a little bit different. We're not really saying, well, we want to be more defensive, less defensive. It's really about actually finding the companies that meet that profile from our perspective. And there are companies out there that applies to. As Joe's pointed out, I mean, one of the good things, if you do happen to have cash on the sidelines, and and our fund allows us to do that, you can take advantage of these periods of weakness that can throw up, when the whole market falls, invariably some things, it can throw up some good value on a long-term basis, and that's what you've really got to be ready to identify when it comes up, and that hopefully was what we do.
And I guess one of the key concerns that the market has at the moment is Glencore and counterparty risks. I mean, just having a look at its last accounts, there's a number of bank guarantees it has on its books. So essentially this could spread not only to the commodity space, but even to the financial space. And, it's a global risk here. Is that a concern, or?
Oh, look, when it comes to banks are probably the most leveraged companies that are out there, and you don't have to look back. I mean, it is a long time for a lot of people, but go back to our last recession in the early 90s, and Westpac had to have a deep discount rights issue. ANZ was in all sorts of trouble. CBA was still government owned at that point in time, and NAB sort of sailed through it. But these companies were heavily impacted because of the amount of leverage they actually have on their balance sheets. That it doesn't take much of a correction in the asset prices for these banks to actually see a significant reduction in the amount of capital they have and the valuation of those stocks. So, a credit cycle when it comes to the banks, that's the greatest thing you really fear with these companies. And if that's the case coming through, particularly given the way that the major banks have tilted their balance sheets towards residential property relative to 30 years ago, where it was much more focused on commercial property and on corporate exposure, it's really the housing marketplace that is the area of risk potentially, and you can see the moves by the banks themselves to try and lessen that risk on a go-forward basis.
Would you be buying the banks right now?
Yeah, look, I've actually been recently doing some work on the banks, I must admit. Look, the banks have come down fairly significantly over the last sort of 6 months or so. And primarily the driver associated with that is concerns, as Joe pointed out, around capital adequacy requirements. And they are taking on a lot more capital. And there's a number of reasons for that. There's international regulations, and there's also APRA enforced regulations as well. Now, from our perspective, I'd suggest that the banks have probably come down to close to a sort of a fair value, assuming we don't get a credit cycle coming through, which is a very big if when we're looking at a deteriorating economy at this point in time, and an economy that hasn't had a recession since 1992. But I think the market, for the most part, has factored in that dilution associated with the additional capital requirements. There are other requirements that APRA alluded to 2 weeks ago, which could have an impact on some of the banks as well, and that's around liquidity, which is yet to really be fleshed out at this point in time. But I also believe that in the oligopoly itself, and in all likelihood, while APRA would like to see most of these costs absorbed by the banks themselves. Invariably, some of it will be passed back to consumers. So, that'll be through higher mortgage rates relative to cash rates, lower deposit rates relative to cash rates as they recoup some of that dilution coming through. And that's something that will probably come through over a period of time as opposed to initially. But having said that, you are looking at banks having lower return on equity. If they have lower return on equity they've had historically, it means that they can distribute less as dividends and still get the same sort of reinvestment for growth that they've had historically as well. So it's always a decision of one or the other, reinvestment or dividend. If you generate a lower return on a marginal basis on the capital, the growth requires you to retain more so you can pay out less.
Okay, so Flight Centre, given the market volatility, global jitters, what the currency is doing, what do you think, Stuart?
Look, it's not one I've had a lot of look at, but it always worries me when you've got a bricks and mortar franchise that is increasingly being competed with by online aggregators of travel services. So, from a cost perspective, longer term, if you think about how this industry is going to evolve over time, invariably it's going to move away from those high street sort of stalls. It's good advertising for them, but it is a cost base that they have to factor into their structure. So over time, you'd expect that it has to migrate online to remain competitive from a cost perspective. The currency is an interesting issue. It's long been expected that would hurt Flight Centre because people would travel offshore less. Obviously, they've got their overseas operations, which they get translation benefit from. But for the domestic business, you would see smaller tickets being written as people travel domestically as opposed to internationally. And there was a concern, obviously, with the profit warning earlier this year that sort of heightened that concern. So that's the couple of things you really got to think about when it comes to Flight Centre.
Sure. Recently, is that, Telstra, a little bit of wobbles there, and TPG Telecom instead seems to be just streaming ahead. So, Stuart, what do you think of these two stocks?
Yeah, look, Telstra is not one we own at this stage of the game. We're not overly yield focused necessarily, and it comes down to we prefer companies that can actually reinvest in their business for growth at a good rate of return. And Telstra is always going to struggle with that, given its position in the marketplace. It's tried overseas, and it really hasn't worked for it for the most part. And you're seeing the aggregation and a lot of corporate activity around the sort of medium-sized part of the marketplace. Obviously, yesterday we had M2 and Vocus announce a merger. We've had TPG and iiNet earlier in the year. So we're seeing increased strength come through, particularly in that sort of broadband marketplace with the NBN rollout, and that does threaten the franchise to some extent, and the core competitive advantage it's held through its networks on a longer term basis.
Okay. What do you think of CSL?
We like CSL. It's not the cheapest stock in the world. It's always difficult to get your head around the valuation of that. And there's a big part of that valuation which is in the R&D platform as well. But they have this low-cost position in IVIG and fractionation that is a very strong value driver, and the growth in that marketplace and the growth in their business, again, the ability to actually reallocate capital at a high rate of return to create value for shareholders is, they've proven it year in, year out for many, many years. So, it's one we like as a core franchise on a longer term basis.
Okay, so healthcare space, what are your thoughts?
Yeah, look, I think radiology is very different to, say, pathology. And one of the key differences there really is around economies of scale. In pathology, you take your blood sample at a location, but generally speaking, you'll send that to a central location for testing. And that's where the scale advantage actually comes in owning a lot of different pathology centres. With radiology, you can't do that. You've actually got to have the imaging equipment in each site. So you don't get the same sort of economies of scale and benefits of aggregating a large number of sites. And the other problem with it is, we find with it, is that the radiologists themselves have a lot of power in the organisation, as do the hospitals in terms of, and hospitals obviously have their own radiation equipment, radiology equipment as well. So from an economic standpoint, from a barriers to entry perspective and just the structure of the industry, from our perspective, radiology is challenged. And I go back to sort of the mid-1990s when May Nicholas was trying to roll up radiologists in addition to pathology assets, and they could never really get it to work for those sorts of reasons. So it's a challenged sort of industry from my perspective.
Or is this a buying opportunity now that we've seen the share price pulling back so much, Stuart?
Yeah, with Ramsay, obviously, it's not just an Australian business. It's got its operations in Europe as well, and that's where a lot of the growth is going to come from, particularly in France, where we see procurement benefits, synergy benefits coming through to drive the earnings on a go-forward basis, and the opportunity for brownfields expansion. One thing we do like about Ramsay is does have that ability to reinvest and grow its business over time. It's got nice defensive characteristics, as you pointed out. It's also got a good exposure to a falling Australian dollar as well. So we like that. In terms of, you get a lot of conflicting statements when it comes to Medibank versus a Ramsay or a Healthscope. They're all saying they're going to get more out of one another. But in reality, a lot of what they talk about is actually improving efficiency in the industry itself. So that's not necessarily a situation where it's gains for one come at the expense of another. It can actually be a win-win for both parties. So, and I think that what you're going to see over time, particularly in the Australian industry, is because of increased sophistication, IT system investment and so forth. Medibank talks about the pathways for care, that integration of the service between the health insurance operators and the service providers can actually produce a better and more efficient outcome. And they will work more directly with and direct traffic to those that are investing with them and working with them to actually provide those better outcomes as well. So, someone like Ramsay, who is a top-in-class operator, could actually benefit from that from a share perspective in working more closely with the big health insurance operators.
So, Stuart, it sounds like you're seeing this as an opportunity.
Yeah, look, as I said, we like it. Again, valuation can appear quite challenging with a company like this, but we do see a good 10 years of reinvestment for growth in this company. So from our perspective, we continue to like it.
Okay, David, welcome to the show.
Yeah, good evening, folks. Look, I've got a particular question. It's particularly for the Montgomery gentleman there. Ainsworth Technology, I realised quite a while ago now you guys, I think you bailed out of it, but now that the dust has settled somewhat, and particularly it seems to me like the American arm of it seems to be still going fairly well. It doesn't have any debt. I mean, my biggest issue with it is that the founding owner still has basically half the company, which makes it fairly thinly traded. But I would really be interested now that the dust has settled as to whether Montgomery Fund would give us some sort of intrinsic value of that stock and what they think its potential is into the medium and long term.
Stuart, what do you think?
I can't give you a hard number in terms of intrinsic value off the top of my head, I must admit. It's a stock I do actually know reasonably well, having done the gaming sector for a decade and a half. In terms of where that company came from, obviously Len Ainsworth was the founder of Aristocrat. He, after giving up control of Aristocrat to his kids and then listing the company, decided that he wanted to get back in the industry itself and formed Ainsworth to compete with his own family. It took them a while to get their product off the ground. They got very strong acceptance and play with their initial algorithm, which is what these things are based on. These slot machines are actually based on. They cloned what they call cloning that algorithm. So they basically take the same algorithm, they produce a different game. It looks different, the graphics are different, but it plays the same way. And they were able to proliferate that through the Australian marketplace very successfully. The problem with that is that as you're building floor share, your ship share, your share of the market in terms of what is actually sold, is a little bit overstated. So once you actually cap out, your volumes actually fall away. And that's what we've seen in the Australian marketplace. They really haven't come up with the next big thing. Now in the US, they're coming from a low base and they've had some success. Much more difficult market to penetrate, but then again, it's also very much a larger marketplace. But really the core of the business remains in Australia, and at this stage of the game, we don't really see that as having a position that they can build off at this stage of the game.
Okay, so I know from Joe. How about you, Stuart?
Yeah, again, it's not a company I really know specifically, but when it comes to the miners, and obviously at the moment there are some cashed up miners, and they're looking at other companies as being an opportunity. While there are individual mines on a global basis that have their low cost position and therefore they have a competitive advantage, the difficulty with mining is the ability to take the cash flow from that mine, reinvest it for growth. It's something they can't do, because you're never going to replicate that asset again. So by buying other companies, you end up buying other people's problems, and all you're doing is really gearing up, financially gearing up your existing exposure around that core commodity. So if you're going to invest in these sorts of stocks, it really is that core commodity price that's going to drive them ultimately. So you have to really think, well, what's my competitive advantage in understanding where that commodity price is going to go relative to the market? And so from my perspective and our perspective, that's something we try and sort of extricate ourselves from, because we recognise that our ability to pick these individual hard commodity prices relative to the broader marketplace, we just don't have a competitive advantage in doing that.
Okay, so lots of good points there by our panellists. That was Independence Group, IGO is the stock code there. Let's go to Bob now from Adelaide. Bob, welcome to the show. How can we help you out?
Oh, hello. Look, Julia, thank you for the show. I think you did a wonderful job today. I know you've been a little bit not feeling the best. Can I just ask the gentleman from Montgomery regarding Surtex, any updates? Or they've sort of been languishing within a sort of trading range for a while. If he knows anything that's upcoming or anything else. Thank you.
Sure.
I must admit, I don't cover Surtex in Montgomery, but actually languishing at the moment in a trading range, that's actually pretty good performance, because the market's been going down pretty sharply for the last 3 months. But yeah, no, there hasn't been any real updates since the result. The result itself we saw as actually being very good. That their revenue growth, in particular their pricing growth, was extremely strong, and that's where we got our key surprise from. So from our perspective, we see this stock as actually meeting our expectations and potentially really exceeding them at this stage of the game. So we continue to like it.
Okay, so liking Surtex. How about you, Joe? I
don't have a strong view on it. It is a recommendation at Share Advisor. It's one of our sister services at the Fool, and they have it on hold. It's been on hold for a little while now, but it's up 400% since the first recommendation, so I can't fault them for that. It is certainly a high-risk play, so it's something you always need to keep in mind with a company that's future is heavily banking on one product coming through or not.
Okay, so that's Surtex in the healthcare space. What about other stocks in the healthcare space that have your attention at the moment or that you're looking at? Joe, what do you reckon?
I really don't spend much time looking at healthcare. Yeah. I'll punt to Stuart on that one.
Well, look, one we've liked and we've been in and out of over time is ResMed. So their results, their last quarterly result, they show a fairly significant pickup and a surprise on the revenue line, primarily from the flow generators. The mask side of things was an improvement, but it wasn't really a massive surprise. Because they make a lower margin on the flow generators, the gross margins were a bit disappointing, but we saw that as actually a good signal in terms of where they're at in their business on a go-forward basis. And we like the fact that you've got that sort of that good leverage to the falling Australian dollar, which we continue to expect to come down. So from our perspective, that one's attractive from our perspective. We like Ramsay, as we said before. We had Surtex, we own a fair few medical ones. We're not so big on the pathology space at this point in time. We think there is, from a short-term perspective, there are concerns around this government review at this point in time as well, and what that actually means for the revenue space for the broader category. The radiology side of things we think is more challenging in terms of that marketplace, as we discussed before. And there's a couple of floats coming out on that at the moment, actually, so there's going to be a few more options to choose from on that one fairly soon. But yeah, the healthcare space is actually one we've liked from a defensive and a growth story, and we continue to do. And we also own Medibank as well, which is another one we like for cost out on a long-term basis and really improving the efficiency of their operation.
Wow, that was there. Do you see any type of interest like that perhaps helping to boost Woolworths? Would you be touching this at all, Stuart?
Not yet. The problem really comes down to, when it comes to supermarkets, what you've got is a lot of fixed cost. At a store level, there's a lot of fixed cost. So if your sales aren't going forward, in particular if your volumes aren't going forward, and if you go back to the 90s under Reg Claire's, when they invested heavily in their DC infrastructure, they automated, they put a lot of automation in, and that fixed a lot of their costs. And so as their volumes grew, their unit cost actually fell at the same time. Now the problem is that they were competing against Coles, and Coles were a very poor competitor. So there was a tilt in the market share in the Australian marketplace beyond what the natural market share of Coles actually was at the time. So with the reinvestment that you've seen in Coles over the last, since Wesfarmers took it over in 2008, you've seen a lot of that share shift back. Now the problem then comes, you've got Aldi coming in as well. Now Aldi have primarily affected the independents, They've largely taken the previous position that was occupied by Franklin's as a discounter, but they've actually managed to create a perception for themselves in the marketplace that is more broad than that. And if you look at the UK example, for instance, what you've seen in the UK is you had Tesco, which was the Woolworths sort of supermarket. It tried to appeal to everybody, the top end of the market, the middle of the market, and the bottom end of the market. They've been segmented by people coming at the bottom, whether it be Lidl or it be Aldi. At the top end of the market by a Waitrose offering high value add finished products and meals and things. And they sort of left themselves in the middle with nowhere to go. And they got chipped away at, so they lost volumes. And when you lose volumes, that fixed cost hurts you badly in supermarkets. So Woolworths is sort of in this position now where Aldi is sort of continuing to chip away. They're growing their store numbers quickly. They're moving now into South Australia and into Western Australia. So that'll have a fairly big impact yet to come as well. So they're going to remain under pressure in terms of that volume and that share story for a number of years yet. So they'll be fighting that slowing volume against their fixed cost base. So what they're doing now is they've instituted a fairly aggressive cost reduction campaign, and they're reapplying that to pricing to make themselves more competitive in the marketplace. The problem there is that with a store that has 30 or 35,000 SKUs, which is a stock keeping unit, an individual item, it will take a long time for the consumer's perception around their pricing to change. Coles wrested the price leadership perception from Woolworths a number of years ago. For Woolworths to regain that perception with the consumer, it's not going to happen in 6 months. So while they might pull their prices down, which hurts their margins at the gross margin line, which will then hurt their overall margins, the volume associated with that is probably 6 months, 12 months away before you actually start to see that recognised by the consumer, such that the strategy could actually work. So from our perspective, I'd suggest at the moment, it's way too early to be jumping into Woolworths, given that fixed cost leverage story.
Yes, the stock code there. This is one of those companies, we've got the baby boomers going into retirement. You'd think that it'd be doing well, but the stock price is kind of all over the shop. What do you think, Stuart?
It's actually performed quite well, particularly relative to the marketplace, and it is one that we really like. We love that demographic sort of story about it, that as people move from 60 to 65 to 70, the nature of their pension investments changes from a superannuation fund to where they're more focused on income. And one thing that we see happening over time is that we note that Challenger is getting onto the Colonial platform at the moment, and they'll increasingly move on to platforms, and it'll become a core part of a superannuation fund and a pension fund, part of the asset allocation decision over time. Now, that will invariably mean that you'll see competition into the marketplace as well. But the growth in that marketplace and their preeminent position in bundling these products up puts in a very, very strong position to grow on a long-term basis associated with those demographics.